Now there's a lot of ways liabilities can be affected, but the idea of paying off a loan and getting a loan will cover most of them. So let's turn our attention to the equities. You see, equity is a very interesting category by itself. There's two different ways that equity can really be affected largely by what's happening inside a company. The first one is you can actually offer new stock. And that's where you go out into the market and you say, I want to sell a little bit of my company that the company still owns in share for some cash. And so when you do this kind of thing, let's say that you're going to sell 100 shares for a par value of $1. We'll touch on what par value means for a second. But your stock price is really worth $10. And you're going to do this because you just want some cash. So how would this transaction work? See, the cash amount that you're going to get from the stock market is calculated by the actual value of your shares in the stock market, in this case $10, times the number of shares that you're selling, which is $100. 10 times 100, $1,000 in cash is what you're going to get from this transaction. So cash is going to go up by $1,000. Now we already know this is going to affect the equity account, because the equity account is all about how much you and how much other people own inside the company. So that thing that we said was par value. What does par value really mean? If you recall back in the balance sheet, we said that par value is really just a fake number that a company makes up that they say is how much their shares are worth. So in this case, we just kind of said it's going to be $1. So for every share that we sell, we put $1 per share under the category called common stock in equity. See, that's where the par value amount will go every time. So in this case, it's going to be $1 times the 100 shares that we just sold for $100 increase to common stock. But Leighton, cash went up by $1,000. Where's the other $900 going to come from? And that's an account called additional paid in capital, sometimes called APIC or APIC. Depends on who your accounting teacher was and if you like acronyms or not. But additional paid in capital is going to show up underneath common stock on every balance sheet in the equity section. And see, that's the difference between the actual stock market price of $10 minus your par value of $1. So $9. $9 times the 100 shares you just sold is $900. That's where the difference shows up at. So cash goes up by $1,000. Common stock goes up by $100, and then also additional paid in capital goes up by $900. Both those are in the equity area code. Now, this is also going to affect the cash flow statement. It's going to happen in the exact same way our debt did, in the cash to or from financing. In this case, it's going to be cash from financing because we are financing a portion of our business. Cash is coming into our business. You're going to see a $1,000 increase in the cash from financing under a transaction called sale of stock or something of that nature. Just the same way that we saw a $10,000 increase from our new loan that we got. Now, let's say that you wanted to use a little bit of your money to actually pay dividends. That's another place that equity can be affected. So there's two things you can do with profit. One, you can keep it. That's called retained earnings, and that goes to the equities. Or two, you can actually give it back to your investors through things like dividends. So let's say that you wanted to give your investors a dividend. Let's say that you want to give them $1,000, more or less. So you have to pay your investors cash because they don't take inventory like t-shirts or machines or anything like that. And so your cash account's going to go down as much as your dividend payment is. So in this case, your cash is going to decrease by $1,000. But if assets decrease, liabilities and equities also have to decrease by $1,000 too. So where's that coming from? So that's where the net profit really ties into it all. As we said, net profit can do two things. One, go to dividends, or two, it can go to retained earnings. Since retained earnings is not going to be as large as it was, since we had money go to dividends, retained earnings is going to decrease as well by that same $1,000. So, once again, our accounting equation works. Assets equals liabilities plus equities. Assets went down by $1,000, retained earnings went down by $1,000, all through this dividend payment. This is also going to affect the cash flow statement in that same place that we did for loans and offering stock, financing. However, this time it's cash to financing since the money is leaving us, kind of like paying off that loan. You see, you're going to see a negative $1,000 in dividend payment on that cash flow statement. And that just means that you paid $1,000 and it left the company, went to investors, things like that. So with all that, we've actually covered how assets, current and long-term, are affecting that cash flow statement, the balance sheet, and the income statement. We also saw how current liabilities and long-term liabilities are affecting the financial statements too, and how the equities and things that happen in those categories are also affecting all three financial statements as well. Now you're ready to dive in and actually do a full-blown financial analysis of an industry.